Let's just jump right into this explainer, guys. Today, we're taking a really hard look at your charts, and we're going to uncover exactly why your breakout setups keep failing. Like, if you've been trading for literally any length of time, you know exactly the pain I'm talking about, right? You spot that absolute perfect level. You wait for the break, you enter the trade, and then, bam, the market violently whipsaws the other way. Well, today we're decoding that trap. We're going to break down the invisible mechanics of the market so you can finally stop being a victim of these institutional maneuvers and instead start trading right alongside the smart money.
So, let's start with a really honest question. Have you ever felt that sheer gut-wrenching frustration of buying a breakout only to watch the market instantly reverse and snipe your stop loss? You sit there staring at your screen like, did the market really just target my specific order? I mean, you mapped out your support and resistance perfectly. You waited patiently for the price to break above that major resistance high. You finally click buy, feeling awesome about your discipline. And then within minutes, or honestly, sometimes seconds, this massive red candle just completely wipes out your position. It leaves you feeling like the whole thing is rigged, doesn't it? Like there's some guy sitting behind a screen just waiting for you to enter so he can yank the rug out.
Look, I totally get it. But I'm also going to hit you with a pretty harsh truth right now. You aren't unlucky. You're just getting used as institutional liquidity. That's it. That's the reality of the game we're playing. Market makers, these massive institutional players moving billions of dollars around, they are deliberately hunting retail stop losses. Think about it. They don't have the luxury of just clicking buy on a huge order without completely wrecking the price, right? They need an incredible amount of opposite orders, liquidity, to actually fill their positions. And unfortunately for us, the average retail trader's stop loss, that is the exact liquidity they're hunting for.
Let's look at exactly how this trap is set up. The whole retail breakout trap relies heavily on textbook trading advice. For decades now, trading books have taught retail traders to jump into a trade the exact moment the price breaks above an obvious high or below a clear low. And I mean, it seems logical, right? A broken ceiling should mean the price is going higher. But here is the massive flaw in that logic. Because everyone has read the exact same textbooks, the big players know exactly where all those buy orders are clustered. They know for a fact that just above that major high, there's this huge pool of pending buy orders from breakout traders, along with buy stop orders from people trying to short the market. It basically paints a giant glowing target right on your chart.
So here's how these market maker tactics actually play out live on your screen. First, they deliberately push the price past those obvious levels. To you, it looks like this massive euphoric breakout. The moment the price crosses that line, retail traders are piling in and the short sellers' stop losses are getting triggered left and right. All of this creates a huge wave of buying pressure. Then step two, the institutions use all that retail buying pressure to seamlessly sell their own massive positions into the market. They're literally grabbing those retail stop loss orders to build their own hidden positions. And then step three, having accumulated all the liquidity they need, they send the market in the real intended direction. The price just tanks, leaving all those breakout traders completely trapped with heavy losses.
Okay, so how do we actually fix this? Well, the ultimate antidote to this problem isn't some magical $50 indicator, and it definitely isn't just guessing. The solution is mastering market structure. Because once you understand the underlying framework of how price genuinely moves from point A to point B, you simply stop falling for these institutional traps. Market structure allows you to essentially read the footprint of the smart money. Instead of just blindly reacting to a single line drawn on a chart, you start reading the entire story the candles are telling you. So, to read that story properly, we need to nail down its two most important concepts.
Concept number one is called a BOS, or a break of structure. A break of structure occurs when the current established trend breaks a structural point in the direction of that trend. Think of a healthy uptrend like walking up a staircase. The market makes a high, pulls back to make a higher low, and then pushes right back up to break that previous high. That upward break, that's your BOS. It indicates that the trend is continuing strong. It confirms that the institutions are still heavily committed to pushing the price in that direction. When you see a genuine BOS, you're looking at a healthy, robust market trend that you can confidently trade with.
But then, we have the second, and arguably way more critical concept, the CHACH, which stands for change of character. A change of character occurs when the market breaks its very first key low or high in the opposite direction of the main trend. Going back to our staircase analogy, imagine you're walking up those stairs, but suddenly the next step isn't higher, it actually breaks completely below the previous step. That drop is your change of character. It's your crucial early warning shot that smart money is flipping the trend. It shows us that the momentum driving that previous trend has suddenly and violently been overpowered by the opposing side.
Just notice the really stark difference here. A break of structure is your trend continuation. It's safe, it's steady, it's confirming its path. But a change of character, that is your trend reversal. And this is exactly where that trap I mentioned earlier is usually sprung. An institutional player might push the price up to create what looks like a final break of structure, triggering all those eager breakout buyers. But immediately after, the price crashes down and breaks the previous structural low, creating a change of character. By visually separating these two concepts on your chart, you can easily identify if the market is just continuing its path or if a major institutional reversal is unfolding right in front of you.
So, the truly crucial part of all this is knowing exactly how to confirm these signals, because, and I can't stress this enough, not every break is legitimate. And that brings us to the golden rule. A true shift in momentum requires a full candle body close past that structural level. I want to isolate this rule right here because it is absolutely vital you don't forget it. If a candle simply pokes its head above a resistance level, or maybe just dips its toes below a support level, but eventually closes back inside the range, guys, that is not a break of structure, and it is definitely not a change of character. The body of the candlestick represents the true, committed volume for that time period. If the body doesn't close past the line, the smart money didn't commit to the move. Simple as that.
Let's contrast this visually so it's crystal clear. A simple wick crossing our level, that is exactly what a liquidity sweep looks like. The market makers drove the price up temporarily with a wick for one reason, to trigger your stops and trap the breakout traders. It's a complete illusion. Contrast that with a firm full-body close across the level. Now this is a true momentum shift. The buyers, or the sellers, depending on the direction, proved they had the actual sustained power to hold the price at that new level by the time the candle closed. A wick does the damage and creates the trap, but a full-body close tells the true story of where the market is actually headed next.
All right, let's pull all of this together into a really actionable step-by-step procedure so you can stop buying those sweeps and start entering safely. Step 1, wait for a clean change of character. Do not, I repeat, do not jump in on that initial breakout. Wait to see if the market reverses and breaks a key structural level with a full body close, proving the initial move was just a trap. Step 2, let the price pull back. Once that COHH is confirmed, the market almost always retraces to retest the zone. This is where your patience seriously pays off. Finally, step 3, enter with the real trend on that pullback, keeping your stop loss safely tucked right behind the new structure.
Now, what's genuinely phenomenal about mastering market structure is that it's completely universal. You can apply this exact blueprint across the board, whether you're charting major Forex pairs, navigating the crazy volatility of the crypto markets, or trading commodities like gold. These rules remain exactly the same. Why? Because at the end of the day, you're trading against human psychology and institutional mechanics regardless of the asset class. The need for big players to sweep liquidity and the way they shift momentum through a change of character happens on literally every time frame in every liquid market in the world.
If this breakdown has opened your eyes to why those old, traditional breakout strategies were just draining your account, please don't keep this a secret. Share this explainer with a fellow trader who you know desperately needs a lifeline right now. We've all been trapped by liquidity sweeps, and this knowledge is exactly how we break free. Oh, and for an even deeper dive, where we actually map these exact concepts onto live charts, make sure you search for The Money Blueprint Zero on YouTube to catch our full masterclasses. You can also find all of our written, super detailed chart guides by looking up The Money Blueprint Zero on Substack. As we wrap up today's explainer, I want to leave you with one final, really important thought to carry into your next charting session. Next time you pull up a chart, find a juicy breakout, and your finger is hovering right over that buy button, I want you to stop. Just stop for a second and ask yourself, are you genuinely trading the real trend confirmed by market structure? Or are you just about to become someone else's liquidity? Start demanding that full body close. Wait for that change of character. Protect your capital, master the structure, and start trading alongside the smart money.